And join us now for more on JPMorgan and the other big banks. Macrae Sykes, portfolio manager at Gabelli Funds. JPMorgan's not your biggest bank holding company, but it's lapped. It's really Jamie Dimon has lapped the other competitors. It's almost $600 billion market cap. The next closest is $300 billion, I think.
That's right. So during his tenure, he's given two gifts to shareholders. So over the 18 years of his tenure, the firm's compounded at 10.9%. 9.8% for the S&P 500 and double that of the industry. So shareholders have been well rewarded against the industry from his tenure. And then the other thing he's done is, as we've heard today, is he's instituted this culture at JPMorgan, a great bench, but a philosophy, making them one of the most competitive banks in the world in terms of risk management, underwriting, and capital allocation.
I think he's incredibly young. At 68. How many could he go? 5 more years? 3 more years? Any indication that we'll hear? Right. He loves it. He's got the passion still.
Well, I mean, if you looked at Omaha, with Charlie and Warren, I mean, they're, decades older than Jamie, and look how well they're doing. So I would think his passion will take him where he goes, and we'll have to see. I mean, it sounds like he's committed for several years now. And, with some of the management changes that we saw in January are kind of more of that positioning for the future without him. But
probably nothing new today on that, further than what they said in January.
Right. I didn't see anything incremental.
Okay. What will we hear today? Well, you don't know, obviously, but what are you expecting? What would be surprising to talk about?
Right. So I think we already got some of the big headlines for the earnings models, et cetera, with the NII guide. I think digging in, people are going to want to hear about technology, how it seeps into all of their businesses. In terms of AI, we've been hearing about automation, standardization of a lot of their processes to improve. And they talked about the guide being $17 billion of tech expense. They earned $50 billion last year, so it's a pretty significant number. And that's up 9% year over year. So they continue to spend and be a leader in technology, and that will help customers going forward, their risk management, and build the platform in a more productive state going forward.
If it's not 20% additional capital, if it's 10, they've already done that, haven't they? Will there be any increased capital requirements from where they are right now?
So I think with JPMorgan, which is fairly unique, is that you have kind of an asymmetrical output to this Basel game, in the sense that they're already provisioned and well capitalized to meet the requirements. But as you discussed earlier, there's potential changes and maybe a loosening of some of those risk weightings, especially with mortgages. So I think you get a bank that's already well positioned in a couple of years to do that. But if you do get a loosening of the regulations, that's upside for investors in terms of share buybacks.
We got to go, but any worries about loan growth or credit losses or anything surprising on that, either of those fronts, you think?
Well, I think that within the hot pockets of the market, CRE, et cetera, there are certainly hot spots, but JPMorgan, well diversified, great balance sheet, great shape to deal with whatever comes forward.